So what do you think, Jill? You know, is next year going to be the year that we see that outperformance that it feels like strategists like yourself have been calling for quite some time?
Thanks for having me. And yeah, I think next year could be a good year for small caps, and we actually could see a good decade for small caps. I think, you know, we've been in this environment where small caps have lagged. We've typically seen them do better at this time in the cycle than we have. And, you know, despite the economic recovery we've seen so far, that hasn't really been reflected in valuations. And now with some of the COVID concerns, the relative PE ratio of small versus large caps is now, you know, collapsed to, you know, extreme lows below where we were during COVID. So, you know, I think a lot of the bad news has been reflected. And if we are in an environment where, you know, Omicron doesn't derail the recovery, small caps are, you know, more exposed to services spending. They're more exposed to CapEx recoveries in the U.S. So we think it could be a good year for small caps.
All right. So it's it's spending. It's the collapse of the PE. What else are the engines here? Are those the main ones that you're banking on to think that perhaps next year is going to be a better year for small caps?
Yeah, I mean, small caps are obviously more sensitive to U.S. GDP growth. So assuming the continued recovery there and that services recovery, since, you know, everyone was spending on goods during COVID, but now we are expecting that services rebound to continue. CapEx spending, which could be furthered by, you know, infrastructure and more broadly the reshoring of U.S. manufacturing. These are bullish themes for, you know, domestically oriented smaller companies. And then I think, you know, if you look back at historical cycles, the last time that we saw, you know, what PE ratios and valuation multiples today are suggesting is that, you know, if you're a long-term investor, large caps right now are very expensive versus history. The PE multiple is now suggesting we could actually see negative annualized price returns for the S&P 500 over the next decade. Last time valuations were suggesting that was in 1999. And whereas in contrast for small caps, which are now, you know, no longer expensive versus their own history, multiples are suggesting we could see, you know, high single-digit annualized returns over the next decade for small caps. And if we look back to 1999, that was actually, you know, what we saw was it was a negative decade for large caps and a very strong decade for small caps. So, you know, obviously not something that happens often, but you can have a period of time, you know, even as much as a decade where small caps see positive returns when large caps are down.
But the problem, Jill, and one of the reasons they're selling off harder than the rest of the market lately is, as you just said, they're super cyclical, tied to the health of the U.S. economy, which is not expected to grow as fast next year as it has grown this year. And in fact, there are downgrades of the economy coming, like the one we just mentioned, if Build Back Better doesn't pass. So if we are in this environment of slower economic growth, especially if the Fed starts raising interest rates, doesn't that hurt the case for small caps?
Well, I think what's important to watch will, number one, be COVID, because that was Omicron news was what we saw coincide with the recent small cap sell-off. And what we found this year, and really since the initial vaccine news in 2020, was that, small versus large cap performance has been very highly correlated with new case counts. So that's something that we continue to watch, and we'll now see with Omicron, if infections are perhaps less severe, could the severity and hospitalizations be more important than just cases? So I think, a more dire outlook on COVID could certainly be a reason to be more cautious on small caps if it leads to further shutdown, significant cuts to GDP, derailment of the services recovery. But what's interesting is that when you look at small cap performance this year, obviously COVID, as I mentioned, has been a big driver. But then looking beneath the surface, it hasn't necessarily been the COVID sensitive sectors that always got hit hardest during the small cap sell-off. So healthcare, where you've also seen issues around lower quality companies, the IPO IPO boom that we've seen, a lot of that has been in healthcare, biotech. Biotech has really been one of the biggest drivers of Russell 2000 underperformance this year. And we've actually seen a historically extreme divergence between the two small cap benchmarks. If you look at Russell versus S&P, where S&P has much less healthcare and biotech exposure. So I think you've also seen this sort of focus on quality, and high quality stocks were one of the biggest explanatory factors of what did well versus poorly within small caps when you look at the recent sell-off. So we have been more cautious on healthcare within small caps for that reason.
Jill Carey Hall, thank you. Appreciate it.
Thanks.